Last time, I started to look at how managing risk more effectively, especially from a portfolio perspective, can have a significant and profound impact on your reward to risk ratios and the smoothness of your equity curve. This time, I look at what causes periods of excessive risk, because until we understand that properly, we can't start to take actions to alleviate that risk. Stay tuned. Darwinex is a UK FCA regulated broker and asset manager on a mission to disrupt the financial trading, investing and asset management industries. As a trader, you'll benefit from cost-effective market access via multiple trading platforms and APIs. These enable trading and investing in any US stock, over 60 of the most liquid futures contracts, FX and CFDs. You can even diversify your portfolio by buying and selling other traders' strategies as investable assets themselves. So, if all of that sounds interesting, learn more by clicking on the link top right now, or find further links in the description right below. Now back to today's tutorial. We can only really put into place a risk management strategy at a portfolio level if we first understand what the problem is that we're trying to address. And that understanding is what I'll be focusing on in today's episode. Let's take a look. In order to explain the real purpose of this, in the first episode I took a look at two individual equity curves. The one on the left here allowed all trades to open regardless of any risk that they posed on the portfolio. And then on the right hand side here, when we were actively managing portfolio risk, this prevented some of those higher risk trades from opening, and as you can see, has a huge effect on the equity curve. And primarily, it's reduced these huge drawdowns that we see on the left. And then in order to quantify the improvements in this, we looked at some of the metrics associated to each of those curves. And by looking at the comparison of the number of trades, we can see that on the left-hand side, we had 25,000 trades making up this equity curve. But on the right, there were 10,000 fewer, just those high-risk ones that weren't allowed to open. That meant we saw a much smoother curve, but in terms of the overall return, this was very similar. So let's now get into the question of what causes portfolio risk. And of course, there are many things that will contribute to that, but I'm going to concentrate on the one that I consider to be the most important. But before I do that, let me just provide some details of the strategy here that you need to understand before we get into the detail. This equity curve was the result of a mean reversion strategy that traded 28 currency pairs. And so theoretically, at any point in time, we could have had anywhere between 0 and 28 open positions. However, in reality, that was much less. And so I think the maximum open at any point in time was 8. But of course, if you were trading this strategy alongside another strategy as part of a multi-strategy approach, then there could have been more positions open at any time in that single account. And they also, of course, have to be taken into account when we're performing our risk assessment. Now, very often, the positions that are open at any point in time might be relatively uncorrelated. They might even be negatively correlated. And when this is the case, this really helps with risk management. Because if one of those positions is moving very strongly against you, it means that another will be moving in your favour, helping to smooth out those drawdowns. So that's a good thing, and that's a major advantage of trading multiple assets as opposed to just a single asset. However, there will be other times when many of the assets that are currently open are much more correlated. And this has the reverse effect. this will increase the portfolio risk significantly. Why? Because if the market starts to move against one of your positions, it's also going to be moving against all of the other correlated positions. And so they're all going to be heading in the wrong direction at the same time. Now, when I performed some analysis of the major drawdowns in this particular equity curve, this was the case in all of those. So using this middle drawdown, which was the worst drawdown as an example, all of these positions were open. Now, what you will notice is that these are all short on the US dollar. So while the positions were open, maybe some US news was released that was dollar bullish, and it caused this huge drawdown. Now, there were actually two more positions that were also open at the same time. One for Euro Yen and one for Pound CAD. And because these are much less correlated to these other 6 assets, these would have actually helped to alleviate the issues caused by the drawdown. So without these, it might have been even worse. Now, bringing ourselves back to correlation, because each of these 6 positions all have the US dollar component, they will all have a fairly high level of correlation. And this is why it's so important that we're able to measure that and calculate it, because only then can we start to make decisions to avoid this situation arising in the future. But there's another major factor, and that is volatility. The more volatile the price action of an asset is, the more the problem will be compounded when we have correlated portfolios of this nature. And so this increases risk significantly, because when those positions start to move against you, the risk becomes reality. So these factors combined, in my personal view, are those that pose most risk to your equity curve. And so the next logical stage is actually calculating what that portfolio risk is at any point in time, but also looking at what the delta or the change in the risk would be if we were to open a new position. Would that risk go down or would it go up? So we need an effective technique to be able to measure and calculate it. And that's what I'm going to start looking at in the next episode. Please do remember to give me a like and to leave a comment if you've got any value from the video. And that just confirms to me that I'm delivering the kind of content that is valuable to you. Also, remember to subscribe to the channel right below, and then you'll be notified whenever new episodes get released. But now until next time, trade safe.